Hey everyone, welcome back. My name's Levi Woods. This is Drawbridge Finance. All right, I'm looking at my mic. It seemed like it's a weird spot today. This is Drawbridge Finance. Not financial advice in any way, shape, or form. Just what I'm doing, what I'm looking at. Would love to hear your comments. So jump in the chat here on YouTube. Let me know. This is real time. Will pull up whatever you guys want to look at, and we'll take a look. I can do an analysis. We can look at some option trade ideas, things like that. See, there's a couple people online. We've got Kevin joining. Jim has said hello. Welcome everyone. And let's get into taking a look at what the market's doing. Don't like to waste anybody's time on here. So we're going to take a look at the S&P 500. This is the SPX chart on the daily. What we're looking at here, I do have a Fibonacci retracement on here. We're coming back, approaching back to these all-time highs. We're continuing bullish momentum. We've got lots of volume up in this level. So, you know, this drawdown wasn't a huge amount of volume on the drawdown over the last couple of months, and we're recovering to these levels. Everything is pointing to continued bullish momentum at this point in time. NQ, we see a very similar pattern. We're slightly above the point of control, which means we have a little bit of volume below the current pricing, but we're almost back to all-time highs, which were back in December. And, you know, we're nice V-shaped recovery. Who knows how that all works, but that's where we are. Russell, we have broken out of the downtrend. We're still under the 200-day moving average. That's that blue line on here. So we're looking at the 200-day moving average. Russell's still trading below that. And, you know, this blue line this straight blue line that I drew on here was looking at the lower highs that we were getting. We've broken out of that, and my assumption is that we're going to continue to see some upside in IWM or the Russell 2000 stocks. VIX trading down at 1692. This red line on this particular chart shows the average price. It's kind of in the middle there around that 17 to 18 level. That's kind of the average zone where we see VIX levels. When we see a volatility drawdown, if we're to look at like SPX, when this volatility occurred in April, we see a correlation between the volatility spiking, and we got quite high. These are quite high volatility levels. So if you were to go back to COVID, which is the last kind of major event that we had, and then obviously August 5th last year, which was a huge volatility spike with the Japanese yen carry trade. But typically we see these retracements happen. So we see large volatility spikes. That's time to sell premium. We step up and we sell as much as we can. And then when we're in zones where we're near this VIX level of that 17, you know, this is where we might trade longer volatility trades, which means we're playing diagonals and not things that are so skewed to having volatility collapse like a short strangle would be. You know, this was an opportune time to put on short strangles. Unfortunately, the moves are often pretty big too. So sometimes it's not a great time to do any play at all. I tend to just kind of put on multiple plays all the time, looking for the best potential setups. Right now, when we're at the VIX level of 17, I'm looking at tons of diagonals, tons of calendars, low risk, high reward potential trades. I've got 7 people online, which is fantastic. One of you has left a like, so I appreciate that. If you could leave a like, that would be fantastic. Let me know where you're watching from, just so I know who's here, and all those comments help my channel. So anything you guys can do to just type away at the keyboard, that I very much appreciate that. US oil trading at 65.18. Let's just go down here, look at the chart. We're seeing some bullish momentum on that. I don't currently have a US oil trade on, and I'm looking for that continued momentum back up towards the $70 a barrel level. Gold trading at 33.23. We're definitely in a consolidation phase. Our point of control and our 200-day moving average are currently below us. So any trades that I'm taking on, even if I do have a bullish assumption, are definitely playing into this potential range where we could get a pullback. Could be rather quick on gold because we've been in this consolidation level for a while, and we can see these large point of controls here up at the 33.25 level and down at the 2900 level, which means that if the market does start to move, if we do get to see a little bit of a breakdown in price, then this move could be rather rapid. And So we could see an easy retracement back down to these levels where we see definite support down around that 29.50 level. So those are the kind of things we're looking at. Silver's been outperforming these last couple of days, finally catching up to gold, and it is definitely outside of the trading range. Point of control is down at $30, currently trading at $36 an ounce. So I know there's lots of speculation that silver is going to continue this bullish trend. If we kind of zoom out and look at the chart, we can see that it is in a bullish trend. The question is, are we going to see a short duration pullback in this? We may not. We'll see what happens. Thank you guys for the likes. I see a couple more of you hit that button. Appreciate it very much. Natural gas, I haven't been playing anything in natural gas. The point of control down at 272. Natural gas can play can shoot up really quickly. So anybody playing these futures has to be very aware of what's going on with their sizing, especially if natural gas was suddenly to explode up to $9. Now let's look at the big underlying, like SPX is flat on the day. So we're basically just even. And part of the reason for that is because all the big underlyings are playing kind of in consolidation zones right now. So if we look at the Apple chart, not a lot of movement. We're seeing a kind of a pennant forming here, where we're seeing this kind of shape. What this generally means is that we're going to see a breakdown or break up one way or the other. I would expect in companies like Apple, we'll actually see a break to the upside, but this is very company dependent. So AMD, it was trading in a channel to the downside, and we've finally broken out of that. And I would expect that we're going to return back up to this higher node point of control around that 158 level. So I'll see continued bullish momentum in AMD at this point in time. ARK, we're trading near the top of its range. You can see this channel that I have drawn on here kind of for this year. We've been moving within that channel for quite a bit. We're getting to the upper side of this. So this is when I start putting on shorts. My patrons know that I put on a short trade today for Arcade, just to give myself some potential to the downside if there was to be, like a face ripping drop, which there could be. I like to have those positions in place before it happens. Now, the interesting thing about a hedge is it doesn't have to cost money. Typically people think that they have to buy puts to get short deltas, but that is not the case. And I'm pretty creative with how I build out my positions. I actually put on a position that if the ARK continues to go up, I make a little bit of money. And if we see a massive drawdown, it will make a good chunk of money. I also play that with a combination of trades that play neutral. So I've got trades that make money in here. I've got that have very little loss in this area. And then I place hedges that will make money in this area and make money in this area. So covering all bases by running a couple of different strategies at a time and overlapping those trades to give myself a very nice delta neutral position that's creating a lot of theta decay. That's kind of the name of the game with these types of things. Why not make money if we can stay within the range, make money in this whole profitable range and then protect from a downside move? It is easily possible, and I have been doing it for a very long time. RGTE, it's coming up with a Russell. So RGTE is a round hill product. I really like these. I am continuing to add these, and these alerts I give out in my dividend tier. So if you guys aren't in the Discord chat, and if you haven't signed up already, please go over to Patreon, join for free. You can get the link to Discord. You can say hello there. I'm online during market hours in the US, and that way I can chat with everybody and we can look at trade ideas. We can do those types of reviews. So I appreciate everybody joining me here on YouTube, but all the action really is on Patreon. Okay, I'm going to take some questions. T Billion says, good evening from London. Easy Money is asking, does the UNH chart look bullish or bearish to you? Let's pull it up and take a look. Do I have UHN? Now, UNH has had, their CEO has changed hands. So boy, there's a lot of volume there. Look at this is why I use volume profiles. We can tell from a couple of things. We can see the volume here at these levels. We can also see the volume at what specific prices they're actually buying. This obviously we missed earnings on UNH recently, and after a couple of earnings beats that we saw, the price is quite low at this point in time. What I would question here is whether or not this is trading near fair market value. I think that's always the question I like to ask, and luckily there's some tools at our disposal. So let's take a look at United Health Group. We're going to look on Seeking Alpha. The quant rating is hold on here, and the valuation is a C+, which means that the valuation is still a little bit on the high side relative to a buying perspective. Now the profitability is an A+, but their growth is terrible. So, is this a good stock to be adding to a long portfolio? Maybe not. Ranked in industry 8 out of 10. Now it doesn't mean that we can't make money off of this. This is where, as an option trader, I look at something like a stock like this and I think, well, where could this be? Where can I make some money? And UNH fair value of 449. So that I think is a very important metric here. Upside of 49%. So we've got two conflicting reports from AI driven software. We've got Investing Pro looking at this and saying there's a fair market value is $450. Current stock price is 301. That's 50% higher than current. And then we look at Seeking Alpha and we see that Seeking Alpha is saying that the valuation is actually C+. It's not that great a valuation at this current time. So it's interesting to look at these, and you take what you may from this. Note that 450 level is actually not nearly anywhere close to where the stock was trading over the past year, which is in that $500 to $600 range. So we're, that we could see some bullish movement on this at any time. Let me, why don't you guys ask a couple of questions, pull up a couple more tickers, and I will pull up. Actually, I'm going to pull up something I don't usually pull up for you guys. Just give me one moment here. I'll show you a little software that I have been working with lately, and I'm starting to get a little familiar with it. So we're going to go to starting to get familiar with it. This particular, I'm going to close this. This particular website is called ORATS, and so this is in the dashboard, but orats.com. So ORATS.com, and they've been nice enough to give me a trial version here of their platform, which is quite complex, and it can build a lot of things, and there's some really cool things in here. So let me just show you how this works. I'm going to type in UNH, which is United Health Group, and what I'm going to do is I'm going to go to the options chain, and this platform is extremely data heavy. There is a ton of value in here in the the skew that we see in options. So we've got our option chain like we normally would, and what we can do is we can build out some trade ideas. So one of the things that I like to do is, say I want a bullish assumption, I want to take a long position in UNH and I want to take some risk. I mean, one of the things that I could do is just buy some stock, but what if I don't want to do that? What if I want to do something that gives me exposure to the upside with potentially less risk or less capital usage? Now, the stock is trading at 302, so I'm going to show you one of the trades that I like to do. Right here at 300, we've got calls on the left as per usual. We've got puts on the right. This is a pretty standard chain. So we've got the 300 calls, and I'm going to build a call zebra on the side here. So that starts by selling an at the money call. Now, typically what we would do with a call zebra is we are spending a certain amount of money. So this call is $2 in the money right now, and it costs about $29.15, which means there's $27 in extrinsic value. Now, if I go over to the right side and I look at the puts, if I look at the 270, the 270 put, you'll see that it has a $14 value, which means that the extrinsic value of the 270s is about 14 bucks and the extrinsic value of the 300s is about $27. So hopefully you guys can understand how that works. Typically with a call zebra, what we are doing is we're selling, $27 worth of credit or worth of extrinsic value, and then we're trying to buy that same amount. Now this is somewhere between the 260, 270 because the amount would actually be about $13.50 for a 2-to-1. And so a typical call zebra is set up in such a way that we buy 2 and we sell 1. And what that does, I'll just turn myself off here. It gives us a position that has 100% or 100 deltas to the upside. So if we look at this, we've got this current position has a delta of 88. So it's the equivalent of owning 88 shares of stock. And when we look at the profit profile, we can see that if the stock goes up from 302, say it was to go up to 450, the profit in this particular case would be, it doesn't actually show it here on the little, theoretical today. It's showing it right here. See it disappear. So if we were to go up to 450, this would be a return of $14,034. Now, typically this would be a $30,000 position, right? If we were buying 100 shares of stock. And in this case, we can do that with a lot less capital. The max loss on this trade, you'll note, is $6,500 because this is how much the call zebra costs. Now, the max gain is actually theoretically unlimited. The stock could go up forever. You could just keep going and going and going. And the probability of profit, 48.74%. So very, very similar to buying shares at today's value. Now, one of the things I don't love about this setup is the valley of death is pretty steep. So we end up with, if the market goes down, we end up in a fairly significant loss. If we compare it to buying stock, if the stock was to drop to 270 and we bought $30,000 worth of stock, we would be down about $3,000. And in this case, we would be down that same amount, $3,000 today, if we closed it today. But if we held it to expiration, we could actually lose this max loss of $6,000. So there's twice as much risk at that 270 level. Now at the 230 level, we're the same risk. It makes no difference. You lose $6,000 or you lose $6,000. And anything below that, there's less risk. But there is a zone between about 230 and 300 that we're actually taking more risk at expiration. So I don't typically play these call zebras like this. It is a very good trade, but what I do is I spend a little bit more money on them. So I will sell 2 of the 300s and I will buy 3 of the 270s. Now this gives me an even greater debit. It's the debit is $8,000, and that means that my max loss is also $8,000, but it gives me a higher delta. This gives me the opportunity here to the delta is 104 comparatively to 88, which means I have more potential of making money if the market goes up. It also means that if the market doesn't go down, I actually, if it just trades sideways, I actually have the possibility of making some money. So if the market at expiration hadn't moved, I would actually make $900 on this trade, which gives me a higher probability of profit. So taking a little bit more risk, but having a greater probability of profit and greater theta decay on this. Now, the ORATs is pretty special. They give us like a distribution edge, a forecast edge, a smooth edge. We can see this graphically. The other thing that we can do with this is we can say, what happens if the IV changes? And that's one of the things that I like about this particular setup, is that if the IV increases on this trade, the loss is relatively low. So in this case, if the market did sell off, we would see that the theoretical return on this, if UNH dropped to 270, the return would just be around negative 193, and then today. So that would be this with the IV increase. So we can see the difference of with that IV increase. And then at expiration, obviously the IV doesn't matter. But this is something that I like more, doing this 2 to 3 ratio than comparatively to a what am I trying to say? Just a regular call zebra, the 1 to 2 ratio. So there's a little more pieces here, and I get a little greater theta decay, and I have the opportunity to make some money. Now, what I'm looking at here is the September, which is 102 days. So this gives me my long deltas, if I want that. I'm gonna click over it. Just make sure my live stream is all working here. You guys are good. Yeah, we're gonna look at all those things. So the next kind of component of this is that what I might do is I might trade a short duration trade against this. This gives me my long deltas. So for $8,200, I'm the equivalent of buying about $31,000 worth of stock. And if I think that the stock is going to go up, say I think that the stock may increase in value to $330, well, I can go ahead and sell that strategy. I can sell the covered call against this. This will cap my profit, but it also, and this reset it, unfortunately. It's one thing I don't love about ORATs, but I'm just going to go back to where it was. So I've got my long, my shorts at the money and my long in the money. And then I now selling a short duration July 11th, 3:30 call as a covered call. So this is like a covered call on a call zebra. And what that does is it gives me a little flatter profit profile. It actually shows that I have reduced probability of profit, which is not actually correct. It should be greater than, because if the market was to drop, that's where my loss zone is. But I'm actually collecting an additional $335 for this. This increases my theta decay to being positive on this trade. And so we have a higher probability of profit. What it's doing is it's capping my max profits. So my max loss is slightly reduced. My max gain is reduced as well. And it's making a little more delta neutral. You'll see again, if the market was to surge, the deltas are only 84 again, but my theta decay is higher. So it depends on what you're watching, what you're looking at. In this case, over the next 32 days, if the stock doesn't jump up like I expect it to, if I'm taking a bullish position, if it doesn't go, then I make an additional $330. That means that at expiration, at expiration, it means that if the market doesn't move at all, I've made a $71 return. If there's any sort of down move, the call is working in my favor, and then you can see the theoretical return is much less of a loss because of the IV expansion that will occur, and we still have the potential of it going up. Pretty awesome. So we can look at different things, different scenarios. If there's a IV loss or contraction, then the theoretical return is actually higher as the stock goes up. So IV plays quite heavily into trades like this, and we have to have tools that will allow us to adjust that what if IV changes. We can also adjust by number of days, so we can look forward and say, where is the profit profile 24 days from now relative to the risk that I'm taking today. So pretty awesome. If you guys get a chance, you can check it out. I don't have a specific link to ORATs, but that is something that may come in the future. So I've got a couple questions. We've got Duolingo. We'll take a look at that right now. Pull it up on. Actually, don't know what the symbol for is. Duolingo. There it is. Duo. 483. Quant rating as a hold, valuation is an F, but great growth, profitability, momentum, and revisions. And that's an interesting field. I don't actually play this stock. Looking back, if we look at the 1 year, has had an incredible growth here, 144%. Year to date, up 49%. My only concern, of course, would be is it overvalued at this point in time? And we can cross-reference that quite easily. We'll just go over to say Duolingo here, and fair value at 305. So potential downside of 37. So we have two different platforms, both showing that we have potential downside. So I would not be going long in this at these prices. I would be considering, putting on option trades to try to capitalize on some sideways to upward movement, but put the bulk of my assumption in that we're going to see a downward tick at some point in time on that stock. Terry says, good morning. Can you tell me how Coney can manage to pay such a high dividend? Oh, the holdings are on 90% Trevor. Okay, and then they only pay single digit dividends. Let me look. I don't know. Oh, well, this is a coin. Okay, so thanks for bringing this up. The Yield Max coin option ETF strategy. So when we look at these, Yield Max is one of these companies that has designed an ETF that gives us long exposure to an underlying, but it's actually an option income strategy. So what this does is it holds, if we look at what it holds in here, it's going to hold some notes, right? So we've got some treasury notes, things like this. And these are just creating some cash flow. But the bulk of this position is going to be in calls, in long calls. So we've got, just looking at where they are here. So we've got, it looks like it's got some short calls. This does not look like the correct setup. Normally what we have in this is we have a long call position. I would assume these are all shorts. We've got a short 250 expiring next week. We've got the short 255 expiring this week and a short 265 expiring this week. These will be sold against a long position. So I'm not really sure if this data is incorrect. What we'd have to do is go to the actual website. We would look at what their holding setup is. But typically the way that these function is that they're replicating holding stock by owning long calls. They're selling covered calls against the long calls. So we're basically doing a diagonal spread. These can pay out massively. It's one of the reasons I use diagonals quite a bit in my own trading. And I'm replicating the same sorts of trade results that we're getting in in a position like this. Let's go back to ORATs, and I'll just show you kind of what that might look like if we were to just do it on coin right now, and you can see kind of how the money generation could appear. So if we look at the options chain, if someone was so inclined to go out a year, 340 days, and they were to buy a 250 call, they're going to put up about $6,500 for this. So if we look at what this does, we've been looking at this type of profile all along. We're looking at what does this give us? This gives us a delta of 65. So it's the equivalent of owning 65 shares of stock, but it's a cost of only 6,400. Now, if we were to go to a shorter duration, like on the June 20th, and we were to look at that 255, what's the 255, right? For next week, it's 250. So they're selling the 250 strike, and for June 20th. So I'm going to scroll down here. We're going to look at the 250 and we're going to sell that. Well, that collects $10.85. When we look at what this profit profile looks like, it creates a large amount of money. The probability is that we're going to stay somewhere in this range. This has got a probability of profit of 31%. Now, if the market goes up, the loss is not crazy. The stock at 255, say it was to go to 300, we're only losing about, where's our return here? Theoretical today, at expiration, we're losing about $1,300. Now, if it was to go down, we have, $1,500 loss. But these are neutral trades. They're playing at the money, and there's tons of theta decay in here. The max gain is only $368, but from a percentage standpoint, can this make money relative to the amount of debit being paid? Well, the debit's only $53.73. So let's just assume that this made $100. $100, and it stayed in that range. If we pull up our calculator and we take a look at what that return on capital is, it's pretty massive. And you'll see how these, I'm gonna have to pull up a screen, a different screen here for a second. We'll get the calculator out, and let's just say that we're doing $100 divided by that $5,400 investment. Then the return on capital is about 1.8%. And this is over the course of 10 days. So we divide that by 10, we times that by 365, and you'll see that this is a 67% annualized return, just doing that setup. And that's collecting $100 a week. When we look at we're looking at holdings, let's look at the dividend on here and see where it is. Well, the dividend payout right now, the yield is 174%. The annual payout is $14 relative to the $8.05 stock. The way that they're doing that is by layering up these positions. Then they're taking the money and they're also holding it in T-bills. So they've got a small percentage of money coming in from T-bills. They have a small percentage of the money in these long leveraged positions, and then they're selling aggressive covered calls against it. They're excellent setups. And when we look at the summary here, you'll see the quant rating is a strong sell. One of the things that we see typically is we see a little bit of decline in the share price. But if we look over time, we definitely have seen that from $19 down to $8. The yield, if it's being reinvested, can function to really bolster this. So using that $14 that we're getting annually to buy more shares can help with that drawdown. Is it a long-term hold? Not really sure the sustainability of these. It really depends on how much covered call income is being generated. But in general, the payout is quite large. So we have to play with caution with all of these positions. Injured myself in the shop. I've got a little Yoda sticker, or a little Yoda bandage on, so you guys can't see my bloody finger. Not that it's bad, but it's just one of those things. And if you're wondering what I did, so I'm out doing stuff in my shop all the time. So it's inevitable that sometimes I mess up and I hurt myself a little bit. Looking at some of these comments, we've got Shamel saying, do you have any strategy that you use to manage an SPX Iron Condor? I'm selling Iron Condor 0DTE daily for around $3 credit and take 50% profit around 2 Delta around 10 a.m. You know what, I don't, I have done tons of daily SPX trading on Iron Condors. I've done flies. I've done conversions into flies. I've done multiple entry Iron Condors. I think if you're looking for a management system on Iron Condors, it really is like a paid type of program. So you can look at like Options Omega to do back testing. Then there's a couple of different programs out there where you could sign up. I don't have affiliate links for those. I don't use any automation, but for the most part, if I am going to manage 0DTE trades, then I think that it's smartest to use bots. It doesn't make any sense for us to just like try to catch it. The moves are just too massive. Like collecting the $3 credit is fantastic. But if I was going to do that type of trade, I am typically just holding to expiration, and I'm saying, you know what, I'm going to try to make as much money as I can on the winning days, because there are going to be losing days, and the losing days are going to be relatively big. If the strategy back tests all right, we typically are looking for a trade that is repeatedly making money, and I don't love closing early on those, because oftentimes we're closing early on the winners. We're making the winners repeatedly smaller, and then the losers become losers anyways. So my experience with it was put them on, let them ride, and I've done better for my 0DTE trading by doing that rather than trying to manage it 50%. I think that the returns are muted when we do that. So that's just my thought. I posted yesterday on your Discord. Yes, I saw that, Shaimal. I ended up doing, I think I just cheersed it. This is one of the things about my Discord, is that I have a free section, free chat. I did respond to you. I said I love this type of setup. I'm a fan of holding to end of day. I also then subsequently went in and put on my own trade, alerted it, and that's in the members section. So I run that fine line of like how much am I posting in the free section, how much am I posting in the paid section, and we have to do that. The reason I charge for this is because it takes a huge amount of effort for me to keep this up. I basically am like working a job by running my Discord, so that is why I charge for what I do. You guys are more than welcome to join or not join or ask questions in the free section, and I will get to them. And if you have more questions, just ask again. What else are we looking at? We're looking at Jim's asking, looking at more SoFi strangles, July 3rd, quantity 3 at the 515, 250, or sorry, the 515, 1215. It's, again, I'm going to pull up our ads, because they have been nice enough to give me this. I'll just show you what the probability is here. So if we go out to the options chain, we're going to look at July 3rd. We're going to sell a strangle, the 1250, and then the 59-cent credit. I mean, it's crazy huge amount of money in SoFi in general. So showing probability of profit is 69% or 67%. Oops, that's the wrong button there. 69%, which I love. We've got a distribution edge of 2.74 and a forecast edge of 2.5. Break even's 11.91 and 15.59. Risk reward is 1 to 7. Again, strangles, nice, solid, positive theta decay. If we do see the market draw down, what if IV changes and the days decrease? I mean, this is easily a loser if we see a move to the downside. So you have to be prepared to say, okay, well, what are we going to do if the market moves to the downside? Now, if the market moves up, IV contracts, then the loss isn't as big to the upside. So it's always the downside. I don't mind this setup at all. I think for people that are running it, SoFi is a pretty small stock. The other thing with 59 cents is that it's pretty easy to define the risk on these. Like you could go out and you could just buy for 59 cents, buying the 18 call caps the upside. So you have no max loss on the top side. You have a capped loss on the upside. And we just never know with these types of stocks. Like it could be one of those things where all of a sudden it's just like goes from $14 to $50. And it would be really sucky to be in a position where we're looking out and saying we've lost a huge amount of money. So I don't mind spending 4 cents a month to define my upside risk and take on a little bit less. I don't like selling naked calls. If you've done it over time and you know how to manage it, the occasional moves just are huge, and so they can be costly. And I prefer to play call spreads whenever I can. Another way to do it is just to play some cheap calendars as well. If you wanted to, like what you could do is you could actually sell. No, you can't sell there, but you can sell like a 16 call and collect another 21 cents and then go out in time. And it depends on how many contracts you're doing too, but you can go out and you can buy like a 20 for you. It's costing, you're getting another 20 cents, you're collecting or you're paying 40 cents. So the initial credit on this trade is pretty big. Or sorry, still pretty big at $41. But we have a maximum loss on this, and we have a little bit more extended range on the top side by adding that little position in there, by adding a debit spread, and or that's pretty cool. You can just turn off, so you can look at how this particular portion of the trade functions. Like what is it doing? That 16 by 20 long position. So by selling where are we here? By selling the 16 with 24 days to go and buying the 20 with 102 days to go, you're creating a profit tent above the current price. So it just kind of increases there. There is a loss to that trade, but it is creating a short-term position that could easily be rolled in SoFi. This would be very simple to roll a short call up and out as time went over the next 100 and something days. So it was something to consider when we're looking at the strangles, either capping that upside or adding something to the top with a diagonal or a calendar to make some money. This, yeah, something to think about. Shaimal, butterfly spread breakdown, long call 143, two calls 146, long call 149, cost basis, debit paid $59. I don't know what Shaimal, can you tell me what one? Oh, NVIDIA, thank you. I see you typing there. Let's go to the options chain. We'll take a look. This is like pretty cool little thing because it shows us so much. So we've got, I don't know when your butterfly is, but let's just see if we can find it here. We've got the short two calls. I'm assuming you're going out. If it's a butterfly, you're going out a little ways. So let's go to, this week. Okay. June 13th. Playing really short duration stuff. 143 short, two calls, and then 146 long and 149. At 149 cost basis. Not sure. You may have mistyped this. You've got the long at 146, long at 148. A long one call at, I know why. I just can't read. Okay, I'm reading here. Let's clear this off. This is why I have a very specific format in my trading room as to how things get posted. So I would write this, when you're writing this out, you would write it all together so that it can't be, there's no spaces in between, but I would write this as plus 143C and then minus 146C times 2 with no spaces, and then plus 149C, and then that gives us a butterfly. And this position, debit 65 cents. You'll see the distribution edge is negative 123. Probability of profit 32.79, and max gain. It really depends on where we think NVIDIA is going to go. You know, these trades can be quite lucrative. If the market goes down, I mean, they're low cost, high return trades. The duration is not very long. So if we were to look, are you taking profits early? Like, are you taking profit on the third day? Then you have a slightly wider range, and I hope you guys can see that there. That purple line kind of widens out depending on which day we're in. So first day, it's got a pretty wide range. Second day, that narrows a little bit. Third day gets even narrower, and then obviously at expiration we have quite a narrow range but higher profit potential. These can be quite good. One thing to consider is potentially legging into something like this. I mean, when we look at what this is two spreads. So you're buying the 206, selling the 85, and if we thought that NVIDIA was going to move, or if we were looking for a weekly move each week, I might go out a little bit further to next week and say preemptively, I think NVIDIA is going to go up. So what if I pre-buy my bull portion? And so you can buy that spread here. It costs $135 to buy out this. Now I've got way too much going on here. Let's clear this all. Let's go to June 20th, and I'll just show you the call spread. The 143. So buy the 143 and then sell the 146. And it's done for debit of 133. And then what if the market runs up at all, you've got a bullish momentum. So if it comes up to that, you know, above that 146, the trade's already made some money. And at that point, sell the bearish portion of the trade, and you end up with a free butterfly. So you can play the direction of this. And we can do it in both ways. You can actually, you can play both sides of the trade. You could say, you could buy either one and then convert either of these to a free butterfly, because now you're going to make money on one direction or the other. So buying a long butterfly could be the start of a trade, and then look for the direction and then convert that into a butterfly on either side. That can work quite well. Now, you know, the return straight out of the gate is you make 50 bucks on a $250 investment, and there's a very high probability of profit, 75%. People don't take into consideration enough, I don't think, long butterflies. Like, we are always selling short because we're thinking about it, but having a 74% probability of profit is pretty awesome. You know, max gain 47 bucks on a max loss of 253, and the likelihood of making that 253 max loss is so slim. Like, you know, it's way more likely that you might lose 100 bucks. So return on capital potential is much greater, and those can work extremely well. So something to consider is a you know, a long butterfly setup. Easy Money says, thank you, Levi, for the UNH trade. Any thoughts on FICO? Let's take a look. What is FICO? I love when you guys pull up stuff I don't know. Fair Isaac Corporation develops software. Outlook. Let's look at a little different something here on ORAT, since we're playing it with it today. That's been a little bit slow, but it's going to run a real-time analysis. And I know there's like all these different things. We've got valuations in F, looking there, and then FICO. I'm going to blast through some of these. At fair value, 1170, 1173, 37%, 33% downside. So, you know, careful with the price there. You know, up 35%, but could easily come back down to this opening level, or the price from a year ago. So that's kind of what the AIs are both saying on both of those. What else are we looking at? We're gonna pop into T-Billion says, thank you. You're very welcome. Gustav says, good morning. Levi just went along on EVVTY. Crazy low valuation. I see it as UNH trade. What is EVVTY? Love when you guys pull up stuff. Evolution Gaming Group, Swedish, 68 bucks. Fair value 105, 53% upside. Is there options on this? Let's blast over here. Let's just go to EVVTY. Did I type that correctly? No, we don't have it here. Okay, so, you know, limitations with all things. EVVTY, Evolution AP, summary. High risk of cutting its dividend. Is this the right thing? High risk of cutting its dividend. What's its current dividend? So we've got a dividend yield of 4%. Dividend growth of 8 years. Last dividend was $3, $68. We definitely, over the past little while, seen stock price go down. Short interest isn't there. Market cap of 13 billion. I'd have to do a little more research out of this. Casinos and gaming ranked in industry 27 out of 29. Doesn't really mean anything to me all that much. Interesting little play. So thank you for that. And what am I doing here? I'm trying to get over to Investing Pro. No. Revenue's dropping. looking at that revenue, net profits dropping. Okay. Thanks for that. I'll do a little more research, but I thank you for bringing that one to my attention. I put it on my list. Andrew says, I'm looking at General Mills covered calls and STZ covered calls. Okay, well, this is where, when we're doing covered call stuff, you know, I like to look at where fair value is. So this is one of the things that I like to look at. If the fair value is very, very close to the current price, which in this case it is in General Motors, I'm pretty aggressive with selling my options against this. And the reason I do that is because it becomes a strategy for making money off of the options rather than trying to make money off of the stocks. So I know some people just go out and they're trying to sell like 5 delta, 10 delta, but covered calls, I like to sell like a 30 delta or even a 50 delta. I might sell at the money. I might sell a 50 call on something like GM. We'll take a look at that other one and then we'll get to some other questions. So STV, STZ rather, sorry, Constellation Brands. Again, this one comes up pretty regularly, but I don't play it. This one's got a 9.8% upside. So again, this is where I'm using these. I like this. I like when it's trading below its fair value. Gives me my bullish assumption, which is what a covered call is. And then I'm taking a look at where I might make some money off of this, and can't really do it with. I don't know how, rather, in ORATs to add the long stock in here. But I can look at the chain and I can say, well, what if I went out July 11th, that's 30 days out, and the stock is trading at 171. I sell aggressively, like the 185. Well, I'm collecting $2.30. That's more than 1% per month. I still have quite a bit of upside potential on this. I have an 89% probability that I'm going to make money on the call. That's going to reduce my overall risk. I've got a max gain of $250. And I have the max loss is based on if I was owning the stock, right? So this is actually reducing my stock risk by capping my max profits on this. But that type of thing I like to look at. Obviously, you have to look at earnings as well. So you have to look at earnings and news and say when is the next earnings, and next earnings July 21st. In the after the close. So you might want to play with that because you'll get more value when the earnings come up. I'm just going to turn myself off for a second. We'll just look at this implied versus actual earnings move, which is kind of a cool feature of ORATs. And so we can see the last 12 earnings where they were. They actually had some relatively large misses in here, and the last one was right in the middle of the forecast. So interesting to look at where we're gonna be. Are we gonna have another massive move to the downside? Yeah. Overall, earnings per share based on actual versus analysts, they're very close on that. So all sorts of things like this. This is a crazy platform. There's so much. It's I've been playing with it, and it's been kind of overwhelming how much information is in here. Okay. And what else do we have here? John Blake says happy Tuesday and hope your finger feels better. Thank you very much. Appreciate that. Terry says, I like that idea. That's going way back to a previous conversation. So I'm glad that you like that. Shamal says, thank you. You're very welcome. Jim gave me a thumbs up. And Conair says, imagine you're in a wheel and the market tanks big like in April. And imagine you don't have much capital to add. Would you be okay to sell a fraction of stock at a loss to buy a leap, to buy the dip? Oh my goodness, I'm pouring water on my face. Would I be okay selling a fraction of a stock at a loss to buy a leap? I have never done that. That's an interesting concept. If we're in the wheel, I've never done it. I've never thought about it. Is it good? I mean, obviously buying the dip is good. Selling a fraction of the stock at a loss. I mean, we always have to look at what is our capital allocation at any given time. We don't have time machines. We can't move back and forth. the question is, are we adding to that risk by taking a leap? I mean, this, if it recovers like the market has, this gives us an incredible opportunity. But if it doesn't, well, we're just adding to our losses. So as long as we're not sizing out, I think that the whole idea with the wheel is that the size of the stock is appropriate to the size of the account. And so when we see that opportunity, we're trying to generate money over the long term, and we're not trying to add additional risk. So the wheel itself is kind of a safeguard strategy in a way. And I don't know if adding leaps into it is smart. I probably would just start with the leap altogether. It's less risk than the wheel. So if we had started with the leap in the beginning, like a unicorn trade or something like that, then we would end up with less drawdown in the long term. But again, losing all our capital relative to holding shares that could recover. And thanks for the clarification, Shamal. We already talked about that butterfly. And then Easy Money's thoughts on PWR or your pick for best in this energy sector. Let's take a look. I still like Enphase Energy. I know it's like a crazy. I'm just gonna pull that up. Strong sell quant rating with profitability is an A+, valuations a C. It's an interesting play, and I have, it's crazy, over the last couple of years I somehow have had just amazing luck with this stock. Like, it is, over the past 5 years it's only up 3%. The dividend is it even non-existent? Yeah, it's non-existent. The premium is just good enough in the options to be able to play this pretty well. Like, you can go out to July, and what I typically do is I'll build a strategy that is like a ratio spread of some sort. So I go out to July, stocks trading at 44.71. You can get 217 for the 40 put just by itself. Like, that's a huge return. So when you couple that with a little bit of a ratio spread, if you sell a 33 of the 35s and then you buy the 40, you end up with a pretty substantial potential to the downside. So let's zip over to ORATs and check that out, and then we'll look at PWR. So you're talking about what I like in the energy space. Enphase Energy is one of those ones, and only because it's just the premiums are high, so there's lots of potential value there. Now I'm not even going to look to see if they have earnings or not. Let me just turn this off for a second. So we have to buy and then sell. And what I want to do is collect the credit. So if I sell 3 and I buy 1 of the 40 puts, I'm still collecting a credit of 62 cents. Now, the other thing I could do is I could buy another position down here a little bit lower. So now let's look at what happens. There's that reset thing. Buying a 25, buying a 40, and then selling 3 of the 35s, I'm getting a credit of 55 cents or 50 cents. And this means that I make 50-cent return. I have an 80% probability of profit or 84% probability of profit. My max loss on this is going to be larger than what it's showing. If I was treating it as a wheel, we're looking around $3,000 total allocation, and the potential of making $50 on that, and minus a few commissions. But it gives an incredibly large probability profit and a very nice profit trend. I mean, making $50 in 39 days is a very decent return on the long term. So if we're looking for stocks like that, this is one of the setups I like on a stock like Enphase, and they have been quite lucrative playing these types of things. So as the stock drifts down, if it does continue to drift down, it just drifts into a profit trend, and I don't mind holding if I'm buying it even a lower valuation than that. Let's look at PWR. Quantus Services. So the summary on here: quant ratings a hold, valuations an F. It's profitable. It's got good momentum. It's ranked number 22 out of 35 in the construction and engineering. and the 1 year chart up 27%. Year to date, looking 9.85%. That always I'm looking at valuation. So, I might play slightly to the downside to this, but I might not be jumping in, going completely long at this point in time, but saying, hey, what if I was happy to get in at the 300 level? And obviously the stock can move quite a bit in any of these scenarios. Moved $8 today. Okay, what else do we have? Thanks, that free fly is a nice one. Yeah, you're very welcome. The flies, like spreads, the way I look at things when I'm looking at spreads in general, I am looking at how cheap is a debit spread relative to the potential momentum that I'm getting. Can I buy something that has a massive potential to one side? These can work extremely well. Then I start to layer it up. I'm like, okay, so now what happens when I'm wrong? So I've got this position, I'm paying a debit for it, but what if I'm wrong? Now that's when I add a calendar. So calendars and diagonals to the downside below, and then trying to build butterflies above. That's the kind of the typical strategy. And if we can do that, then we're taking advantage of the extreme theta decay that occurs on the butterfly in the upside when the IV is contracting, and we're taking care of IV expansion on the diagonal side. So diagonals below, butterflies above. When we build them like that, they can be very, very lucrative strategies where we're using low amount of capital for potentially high returns. If we can then leg into those and manipulate portions of it, we can then build a trade that performs even better. No, Andrew says General Mills, not General Motors. Yeah, did I say General Motors? Yeah, I just thank you. I knew that, but I appreciate the feedback. General Mills, yes, GM General Mills. Yeah, okay, we are going to get out of here. It has been amazing. We are trying to get rich together. It's 12 o'clock. Thank you so much. I will see everybody else on Thursday, everybody that's in my Discord chat. If you're not already there, head over there. Check out patreon.com/drawbridgefinance. Sign up for my free newsletter and get the links over to Discord. Thanks so much, everybody. Take care. Bye.